Hi, class, and welcome to Chapter 9. Chapter 9, we're going to get into bond yields and valuation. The word valuation is a unique term that is associated with the stock market, and we don't ever hear that word, valuation. I call it evaluation when you're evaluating a bond. Bond yield means the amount of money you're going to receive from the bond that you've invested in. That's what the yield actually indicates. Definition of bond valuation. Bond valuation is a technical term for determining the value, the fair value of a particular bond. Bond valuation includes calculating the present value of the bond's future interest payments, also known as its cash flow, and the bond's value upon maturity, meaning when it is actually paid, also known as its face value or par value. We covered this in an earlier chapter, but this is actually giving you more detail and background on how to evaluate an individual bond, meaning determine its value. Bond valuation is less glamorous than stock valuation for two important reasons. First, the return from investing in bonds are less impressive and they're fixed. Secondly, bond prices fluctuate less than equity price, which means the amount that you're normally hopefully anticipating getting on your yield is going to fluctuate. Bond returns. Bond returns can be calculated in various ways. One way is to understand the coupon rate, current yield, spot interest rate, and yield, I should say, to maturity. Year to maturity, I keep saying the word year, yield to maturity, and the coupon rate. What's the relationship between the yield to maturity and coupon rate? Well, you're going to deal with basically coupon rate is the bond is selling at par, which is meaning the amount of money, say $1,000, is what it's selling for. The discount is below the par actually, and then the premium is above the par, which is the asking price of the bond. Why does the year to maturity differ from the coupon? Well, the coupon is set when the bond is actually issued at $1,000 or whatever the price actually is, the face value of the bond. The year yield to maturity is the market's required interest rate. It may change as the economic fundamentals shift, which means our economy. Things get a little different over time, and maybe your bond is not as worth as much due to the economic situation. Yield to maturity. Yield to maturity is an important number in bond valuation. It is the rate which equates the market price of the bond with the value of the discounted cash flows. This is yield to maturity. It is the R such as that the bond equals the holding value. Finding the year to maturity requires a financial calculator, a goal-seeking solver, and trial and error for the most part. Characteristics of bond prices. What are the characteristics of bond prices? The cash flow on a bond are consistent, which is fixed income. A bond's price or market price changes in response to the market interest rate. When market rates increase, the fixed payment from the bonds are worth less, so the price falls. And the inverse occurs. If the rate decreases, the fixed payments are now worth more. I'd rather be on the other end of that. Basics of bond valuations. Here's the simple basics. The bond price equation consists of two components. One is PV, which we know which is present value of coupons. The other is present value of face value. So the price of a bond, these present values, depends on the discount rate, the number of periods, size of cash flow. And you can see by that formula below, you can punch that into your finance calculator and or financial calculator, and it'll spit out the bond valuation. Duration refers to, as seen, bonds have value for two sources, coupons and return of principal. Intuitively, Bonds with high coupon rates or short maturities will return value more quickly than those with low coupons or long maturities. And that makes sense. At the extreme is a zero coupon bond, which returns all value at maturity, every bit of the money that it was worth at maturity. Duration is a measure of how quickly the present value of a coupon is actually returned. More duration. To calculate duration, find the present value of each cash flow individually. Sum these to get the present value of all cash flows, which is the price. Calculate the proportion of the total value from each individual cash flow. Multiply each proportion by the corresponding number of periods and sum. Do a summation at that point. The answer will give a measure of the average life of the bond in a present value sense. Bonds with a low duration gets most of its value from cash flows occurring early. Types of risk bondholders face. These are some of the risks that actual bondholders face. Interest rate risk, we definitely know that. Reinvestment risk and default credit risk. Let's cover each of those. So, interest rate risk basically is the risk of a bond changing in value when the interest rate changes. This affects all bonds regardless of credit bonds, but is more severe for long maturity bonds. That makes total sense. Reinvestment risk, the risk that investors will be unable to reinvest the coupon payment at the coupon rate. This is more important for high coupon bonds. And default credit risk, the risk that the firm will be bankrupt and not make all the payments to bondholders. Something also to consider is inflation and interest rate. Inflation is the increase in the nominal or cash cost of goods and services over time. Put differently, it is the decrease in purchasing power over time. Also, in the end, we are generally concerned with the consumption in finance and in life, the amount of dollars you have to really much less important than their purchasing power. Nominal rates are the rate observed in the market and quoted in contract. Real estate rates are actually very elusive since measuring inflation accurately is extremely difficult. And at that point, folks, that is the conclusion of how you're going to evaluate bonds, bond valuation in a nutshell.